So, January 30th, a single name drops, and suddenly global markets are in a tailspin. That name, Kevin Warsh, the nominee for the next chair of the Federal Reserve. And the market's reaction was so wild, so immediate, it left everybody asking the same question. Is the entire playbook for American money about to be torn up and rewritten?
I mean, the reaction was just brutal. Take a look at gold. On the day of the announcement, prices just fell off a cliff, down over 10%. We're talking about the worst single-day drop in more than a decade. Months of gains, just gone in a matter of hours.
And if you think that's bad, silver had it even worse. It collapsed by over 30%. That's its sharpest one-day fall since 1980, a truly historic plunge that pretty much nobody saw coming.
Okay, so here's the puzzle, right? President Trump made it very clear he picked Warsh because he wants to lower interest rates. And markets usually love hearing that. Lower rates are supposed to be good for assets like gold and silver. So why the absolute bloodbath? What are we missing here? Well, to get to the bottom of this, you first have to understand the man himself. And Kevin Warsh, well, he's a familiar face in these circles, but he's also a bit of a walking contradiction. And that's really the key to this whole story.
See, Warsh is no rookie. He was a Fed governor right in the middle of the 2008 financial meltdown. But then he did something pretty unusual. He quit. In 2011, he resigned because he was dead set against the Fed's second round of money printing, what we call quantitative easing, or QE2. He basically said the Fed was doing way too much, and for years, he's been one of its loudest critics.
And this slide right here, this lays out the paradox perfectly. On one hand, you have the old Warsh, the classic hawk. This is the guy who was always warning about inflation, always skeptical of easy money. But on the other hand, you have the nominee, the Warsh of today, who's suddenly calling for interest rate cuts. His big argument? That a huge productivity boom from AI will keep inflation in check. And look, this isn't just speculation. The president himself said it out loud before the nomination. He thinks you have to lower interest rates. So you've got this famous inflation hawk chosen by a president who wants lower rates, who is now arguing for lower rates. So what on earth is going on?
This is the key. This isn't just a simple change of heart. Warsh is proposing a completely new, radical framework for how the Fed should operate. People are calling it the Warsh Doctrine. And this is what sent markets into a panic. He calls the idea pragmatic monetarism. And at its core, it's a plan to do two things that sound like they completely cancel each other out. Cut short-term interest rates, while at the exact same time shrinking the Fed's enormous portfolio of assets. That shrinking part is what we call quantitative tightening, or QT. So his plan really has three parts. First, he's making a massive bet on AI. He thinks it's going to be like the internet boom in the 90s, supercharging productivity and keeping inflation low. Second, because inflation is no longer a problem, he can cut short-term borrowing costs to help people and businesses. And third, and this is the real kicker, he wants to aggressively shrink the Fed's $7.3 trillion balance sheet. And why is he so obsessed with this? Well, it all comes down to his core belief that the emergency tools the Fed started using back in 2008 have stuck around for way too long. He thinks this giant balance sheet has created something he calls monetary dominance, where the Fed's actions are basically propping up massive government spending and blowing dangerous bubbles in the markets. Okay, so let's connect the dots. How does this grand, complicated plan explain that chaotic market reaction we saw at the beginning? Well, once you understand the doctrine, the craziness actually starts to make a whole lot of sense. You see, the market wasn't just reacting to the promise of lower short-term rates. No, it was reacting to the whole package, especially the idea of the Fed pulling trillions of dollars out of the system. Why did gold and silver crash? Because the fear that the Fed would just print money forever, what they call currency debasement, vanished overnight. Why did the dollar get stronger? Because a smaller balance sheet means fewer dollars floating around, making each one more valuable. And long-term bond yields, they shot up because traders got scared the Fed would start dumping its bonds on the market. Think of it this way. The interest rate cut is about the price of borrowing money in the short term, but shrinking the balance sheet is about the quantity of money in the entire system. And what the market heard, loud and clear, was that in a Warsh world, the total amount of dollars is going down. Money itself is about to become a lot scarcer, and therefore a lot more valuable. So let's zoom out, because this is about so much more than just one guy. This nomination could signal the end of an entire era of monetary policy.
The era of constant, massive central bank intervention that has defined our economy ever since the 2008 crisis. What would this new chapter look like? Well, it would mean a Fed that's trying to do less, not more. It's a huge pivot away from that crisis playbook. It means getting back to a much narrower job, just focusing on keeping prices stable. It means tools like QE are put back in the emergency-only toolbox. Warsh has even talked about a new Treasury-Fed accord, basically redrawing the lines between the government and the central bank to make the Fed truly independent again. Now, of course, we have to say that this is all for informational purposes. This is not and should not be taken as financial advice. You should always consult with a professional before making any kind of investment decision.
Which leaves us with the big, multi-trillion-dollar question. The Warsh Doctrine is a fundamental break from everything we've known for the past 15 years. So is it the tough, disciplined reset the economy desperately needs to get back on solid ground? Or is it a massive, high-stakes gamble in totally uncharted territory, ripping away the support from a system that's become addicted to it? The answer is going to shape the global economy for years to come.